All right, so we're going to talk about types of financing. There are three main types of financing, actually four, but on the residential end, there are three main types of financing. The first one is conventional financing, usually conventional, that's how people understand it. And what is the difference between conventional and, for example, FHA? So the main difference is that conventional loans are backed by private lenders or banks or private lending institutions. FHA, on the other hand, is backed by the Federal Housing Administration. And whenever you see the word federal, what does that mean? The government. And then there is also another entity tied to FHA, which is called HUD, Housing and Urban Development Corporation. Again, another government entity. FHA and HUD go hand in hand. So now let's talk about conventional loans. So conventional loans. A conventional loan has a few characteristics that makes it unique. A conventional loan is not regulated by the government, thus it can fit in different molds. You have Freddie and Fannie Mac conventional loans, and then you have other types of conventional loans. The main difference is that a conventional loan, when an appraiser is going to do the appraisal, the appraiser doesn't have to look for certain requirements in terms of how the property needs to be. For example, on the FHA loan, when the appraiser goes through the property, there has to be handrails if there are 3 or more steps. If there is chipping paint, the appraiser has to call for that to be fixed, because if there is chipping paint, there is a lead-based paint hazard. And because it's a government loan, then there's a problem. Conventional loans don't have that. Okay? Conventional loan can go as high as 100% financing. FHA does not allow 100% financing. Conventional loans can be 100% financing, 3% financing, 5%. It varies. Also, one of the biggest differences between a conventional loan and an FHA loan is also that when you put 20% down on a conventional loan, you don't pay mortgage insurance. Okay? On an FHA loan, if you put 20% down, you will pay mortgage insurance. And how do you say mortgage insurance? MIP, mortgage insurance premium. You also call it PMI, private mortgage insurance. Again, what you would think that this insurance is for the client. No, this insurance is for the lender. Why? Because if the buyer defaults on the loan, then the private mortgage insurance that is paid in the mortgage payment by the buyer insures the loan to a certain percentage for the lender. Because if your buyer defaults on the loan, this company will pay back some money to that lender. Okay? So main differences between conventional and FHA loans is that conventionals can go up to 100%, and it could be any amount of down payment, and the private mortgage insurance goes away if you put 20% down. Also, once you hit 78% of your loan to value, that means you already paid down your loan to 78%, or your house has an increase in value, you can cancel the mortgage insurance. So your payment will go down. On FHA loans, the mortgage insurance never goes away. It used to go away after 12 years. Now it never goes away. So on FHA, on conventional, you also have loans that you can get money to do repairs. And FHA, you also have loans that can have money for repairs. So let's talk about FHA loans. There are two types of FHA loans. Regular FHA, which requires 3.5% down and up to 6% assist, as long as it doesn't go above the 3.5% that the buyer needs to put down. So every buyer needs to put at least 3.5% out of their own pocket. There is only one exception. Sometimes when you get grants, the money from the grants is considered money from their own funds. So that could be part of the 3.5%. So there is a lot of stuff that you don't need to know. That's why you have a lender. The main thing is that FHA loans require a minimum of 3.5% down, okay? And you can get up to 6% in seller's assistance, which will help your buyer buy the house with less money out of pocket. So this is key when you're trying to help people buy properties with little money. You can get them 6% seller's assist, you can get them grants, and you can get a bunch of things. So you can help people buy a house with no money pretty much. Then the third type of residential lending is called VA. And what is a VA type of loan? V stands for veteran, and then A for affairs. This loan only can be given to someone who has been in the military. Now, this loan has a lot of positive things. And if you're a smart agent, you will cater to the VA personnel or people who have been in the military, because you can buy a property with a VA loan 100% financed. Another beautiful thing about it is that you have no mortgage insurance, although you get 100% financing. Okay? And I believe there is no fee for the appraisal. And then you don't have to put up any money, no down payment, and also you don't have to put any money out of your own pocket if you don't have to. Meaning that you can get up to 6% seller's assist, and if you have any grants, you can buy the property with $0. So who will not want to cater to the veteran community? They can buy houses so easily, but people forget that this is a huge community that you can teach them how to buy houses. This is a niche pretty much. Okay? So now these have to be owner occupied. Then now you have commercial lending. Okay? Commercial lending applies to properties that are being bought by an investor. Okay? Now, that doesn't mean that an investor cannot get a conventional loan. And I'm going to tell you the difference. An investor using a conventional loan can have up to 10 loans in the conventional way, or conventional loans. Remember, these 10 loans will show up on his or her credit, because these loans are given. An investor can have up to 10 conventional loans on their credit, okay? And it will show up on their credit. Once you hit 10 loans, you will not be able to get a conventional loan because they're backed by Freddie Mac. And this is a little more technical, but I'm going to touch briefly on it. Freddie and Fannie. Have you guys heard the term Fannie Mae? These also are government regulated entities. So once you hit 10 loans, conventional loans, you cannot get any more, because these entities that regulate these type of loans say no more. They don't want to risk anymore. Everything related to financing is based on risk. Then once you hit 10 loans, you can't go conventional anymore. What do you have to go? Commercial. You can also only have one FHA loan and one VA loan. Again, 10 conventional loans. But then you need to go, if you want to buy more properties, you need a commercial loan. And there is different types of commercial loans. There is hard money, which interest rates are higher. They don't ask questions. They don't require income proof. Then there also are regular conventional loans with regular banks where they will ask you for documentation to show that you are a qualified buyer. Now, on commercial loans, the approval of the loan doesn't depend on the individual. It happens on the property. So for example, you're buying a duplex and each unit rents for $1,000. How much is that? $2,000 a month, right? The bank will make sure that this $2,000 is enough to cover taxes, insurance, vacancy, repairs, property management, and then the mortgage. So when they do their own calculations, and if the property with those $2,000 cover, we call it debt services, the loan, then they'll lend you the money, not because of you, but because of the property. So the commercial loans go 100% based on the asset that you're buying to make sure that the asset can cover the loan. Also, they check your credit, of course. So if you're someone who has bad credit, they're not going to give you a loan. If you go to hard money, they will give you a loan, but they're going to give you high interest rates, like 12, 13, 15%. Okay? And they will charge you a lot of points. A lot of point, 1 point is equivalent to a 1% of the loan. So what is 1% of a loan? Let's say we have a loan of $100,000. What is 1% of $100,000? $1,000. So if the loan is $200,000 and they want to charge you 1 point, that's $2,000. But let's say they charge you 5 points. On $200,000, 5 points is equivalent to $10,000. Because you take 1 point of 200,000 is $2,000 times 5, that's 10,000, right? Very basic math. Get it? 1 point equals 1% of the loan amount. If the loan is for 200,000, then it's $2,000 per point. If it's 5 points, it's 10K, okay? So, to recap, 4 types of loans. Conventional can be 100% financed. Mortgage insurance, it goes away once you put 20% down or you pay down your loan to 20 or 22%. You can have up to 10 conventional loans that are Freddie Mac approved. You can use conventional loans to buy your primary residence or investment properties or vacation homes or second homes. FHA, 3.5% down minimum. Mortgage insurance never goes away. You can get up to 6% in seller's assist. Your client needs to put down 3.5% of their own money, but some grants go towards that. So technically they can buy the house with very little money. VA loans are for veterans. They're 100% financed, and the buyer doesn't have to put any money out of their pocket, so they can buy the house with no money pretty much. And you can get up to 6% assist. Commercial loans can be as crazy as hard money, where they charge you high interest rates and a lot of points, and they don't verify income, they don't care about your credit or your criminal history. Or you can go to a typical commercial loan that goes to a regular bank where they verify your income, but in both cases, they care only about the asset and make sure that the asset cash flows and debt services. Cash flows means that it has leftover income, and debt service means that it covers the debt payment from the income that it generates. Okay?